In this week's video, we'll answer 3 important questions about the current stock rally. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We'll kick off the video with a quote from a trading psychologist. The key determinants of investing and trading success are not one's feelings of confidence, but the objective realities of the marketplace. If you follow along on Twitter, you may remember this tweet from earlier in the week. And the first question we'll examine that helps us assess the market's current risk-reward profile is, does asset class behavior align with the early stages of a new bear market? Throughout the entire video this week, we'll be using weekly charts with these generic and even numbered moving averages. Exponential 16, 18, 20, and 22 week moving averages. Clients and longtime viewers know that this is a full bore bearish look here with the fastest moving average blue on the bottom, and all of the slopes of the moving averages are down. Conversely, a full bore bullish look is almost the mirror image with the fastest moving average blue on top, and the slopes of all of the moving averages are positive. This is the peaking process in the S&P 500 in calendar year 2000 as the dot-com bubble began to deflate, and this is the bottom following that bear market. In between, there was a 50% plus decline in the S&P 500. And then in 2003, the market started to take on more of a constructive look. These same weekly moving averages had somewhat of a hesitant look heading into the U.S. election. And ultimately, when we get these tight clusters here, typically a tight cluster is followed by a big move. A tight cluster can be followed by a big move. You can see as we head into the election, we are starting to cluster here. And the moving averages are starting to roll over in a bearish manner. However, blue remains on top. We never get bearish moving average crossovers. This is just somewhat of a waning momentum look. If we fast forward to the present day in early February of 2017, we can see the present day here is a full bore bullish look with blue on top, and the slopes of all of the moving averages are positive. And from a pattern recognition perspective, the present day looks a lot more like the right side of the screen and really doesn't look anything like this low probability look here that we want to avoid. Similar situation here, and these charts are helping us answer the question, does the present day, the facts that we have in hand right now, look like the early stages of a bear market? This is the early stages of a bear market. There's your tight cluster. Slopes are all down, and eventually we move to a full bore bearish look here with blue on the bottom. Understanding what a constructive look looks like can also help us answer that question. Here's our constructive look, our tight moving averages here, some indecisiveness, and then we move into a full bore bullish look in calendar year 2009. And from our previous example, we know the present day looks a lot more like this constructive look here than the concerning look here, or the early stages of a bear market look here in calendar year 2007 and 2008. Moving on to the second question, is asset class behavior on our time frame flipping to a defensive bias? Common economic sense tells us that when fear starts to increase, the demand for defensive-oriented bonds will pick up relative to the demand for growth-oriented stocks. This is a defensive look here with the ratio of stocks to bonds rolling over. We get that tight cluster look here late in 2007, and we have a full bore bearish look here. This is ultimately the look that we want to avoid. This is the look from a probability perspective that we want to embrace. using the same ratio, this is SPY in the ETF world, relative to AGG, which is a diversified basket of bonds. In February of 2017, are we seeing a shift to a defensive bias? In early November of 2016, we have somewhat of that tight cluster look with an indecisive move down and then up, tight cluster here, and we know big moves often follow tight clusters. If we fast forward to the present day, in early 2017, we can see that the ratio of stocks to bonds are risk on, risk off, or growth relative to defensive assets has a full bore bullish look, and it looks a lot more like this constructive look in calendar year 2009, and really doesn't look anything like that shift to a defensive bias that we want to avoid. Since a trend is a trend is a trend, and math is math, regardless of what we plug into the February 2017 chart, this is ultimately, from a trend perspective, the look that we want to avoid, and this is the look from an odds perspective that we'd like to embrace. Therefore, we can gain some insight into the potential shift to a defensive bias by looking at long-term treasury bonds, or TLT. This is our avoid look here, with the slopes, all of them are down and blue is on the bottom. The slopes, all of them are down and blue is on the bottom. From a probability perspective, this is an ETF that we would like to avoid right now, and it tells us something about the market's current tolerance for risk. Similar situation for physical gold in February of 2017. The look of this chart, even though these MAs are starting to turn back up a little bit, still looks a lot more like the left side rather than the right side. And if we compare physical gold, $GLD, to the S&P 500 here, so we're looking at gold relative to stocks, again, we see the look of the chart in 2017 still looks a lot more like that avoid look. Therefore, a defensive asset does not appear to be turning in a bullish manner on February 2nd, 2017. Now we're flipping the script a little bit here. We're looking at XLP, or defensive consumer staples, relative to the S&P 500. This is the peaking period for the S&P 500. This is a defensive bias look. This is what a stock market top looks like. Conversely, this is what a stock market bottom looks like. This is 2002 and 2003 here. As we might expect, when the stock market is peaking and fear is increasing, the conviction to own defensive-oriented XLP is higher than the conviction to own the general stock market. This is rising defensive conviction. And from a stock market perspective, this is a defensive bias. This is the look we want to avoid. And conversely, this would be the look that we want to embrace. Common sense tells us that the demand for defensive XLP should be waning as the stock market is bottoming in 2002 and 2003. And that's exactly what we have. Therefore, in the present day, does this ratio look more like the avoid stocks or the defensive bias, or does it look more like a growth bias in the type of market that has favorable odds that we want to embrace? And the answer is relatively simple. The look we want to avoid, blue is on top and the slope is positive. The look we want to embrace, blue is on the bottom and the slope is negative. Blue is on the bottom and the slope is negative in early February 2017. Moving on to the next question. From an asset class perspective, are there better places to be? Clients know that we have a growth-oriented portfolio right now. Therefore, we can look at the intermediate and long-term trends in the S&P 500's market sectors using the SPDR ETFs. Regardless of what we look at, this is the look we want to avoid, and this is the type of favorable look we want to embrace from a probability perspective. We're using the exact same moving averages here. This is Friday, February 3rd, 2017, we're looking at growth-oriented technology stocks relative to defensive-oriented bonds. This is the type of look that we want to embrace. Favorable odds. Really doesn't look anything like the avoid look over here on the left side of the screen. Similar situation with banks versus utilities, February 3rd, 2017. We still have a favorable look. And if we look at energy XOP in this case relative to TLT, we still have a full bore bullish look on Friday, February 3rd. And it really doesn't look anything like this peaking process that we would want to avoid in calendar year 2000. Growth-oriented materials, XLB, relative to defensive-oriented healthcare, XLV. We have a full-bore bullish look, materials relative to healthcare, and that tells us about probabilities looking out weeks, months, and years. We're not talking about minutes, hours, and days here. Industrials, XLI, relative to REITs, IYR, still maintaining a full-bore bullish look in favor of industrials. How can these three questions help us? Are there better places to be? Is asset class behavior flipping to a defensive bias? And does asset class behavior align with the early stages of a new bear market? From a probability perspective, when the answers are no, it helps us discern between volatility to ignore, volatility to ignore, volatility to ignore within the context of an ongoing uptrend. Conversely, if the answer was yes, asset class behavior aligns with the early stages of a new bear market, rather than ignoring volatility, we may hit a mathematical stage where we need to take some action, and that would be volatility to respect. So the math and the questions and asset class behavior help us discern between volatility to ignore and volatility to respect. And we know from past videos that even within the context of an incredibly strong trend, this is a weekly chart, this is calendar year 2013, we studied this rally here into calendar year 2015, and even in the context of this extremely strong trend, 44% of the trading days were red days, meaning we know in advance, even within the context of a rising trend, that there's going to be a lot of volatility to ignore periods. Trends and the answers to the questions, or more importantly, asset class behavior, can help us with this topic. From Market Wizards, it's always tempting to liquidate a good trade on flimsy evidence. If there's not a better place to be from a probability perspective, then most likely it's best just to look the other way during givebacks and red days. The answers to the questions, asset class behavior, and the math tracked by the model, they help us get from point A to point B, which in this case, in calendar year 2013, is roughly a 30% gain, by classifying most of these moves as volatility to ignore. Why is it volatility to ignore? Because if we ignore the volatility from point A to point B and hold our positions, then we have a much higher probability of capturing the gain from point A to point B. We know with 100% certainty that pullbacks and red days are a normal part of every single bullish trend in stock market history. Therefore, if we mentally prepare for that in advance, when the inevitable volatility comes, it's much, much easier to classify it as volatility to ignore when that's what the math says and that's what the answers to these three questions say. To provide an anecdotal example of how the math can be helpful, if we're just looking at price here, it may be very, very difficult to hold from point A to point B. But if we add in the generic weekly moving averages that we've used in this video, you can see from point A to point B in this case, and we already said this was a very strong trend. During the entire move from point A to point B, we have a full bore bullish look that would classify all of these givebacks as volatility to ignore within the context of an ongoing and existing bullish trend. If we circle back to August of 2016, and this is the period here where the evidence really starts to turn in favor of bullish outcomes from a probability perspective. When we perform this analysis in August of last year, we have no idea how long the constructive and favorable charts will hang around, just as we have no idea how long the constructive and favorable looks will hang around in calendar year 2017. And that's why we take it day by day. No forecasting under our approach. If we went back and reviewed these topics that we've covered in the past, we still have a situation where the weight of the evidence is favorable as of Friday, February 3rd. What happens tomorrow or next week or next month remains to be seen. To recap, during the course of this video, we reviewed numerous weekly charts, some of them indices, some of them risk-on, risk-off ratios, some of them growth-oriented assets, and some of them defensive-oriented assets. Everything that we've reviewed is classified under the objective realities of the marketplace. We're reviewing hard data and evidence that we have in hand, objective realities. There's nothing subjective about the current look of this chart. At some point in the future, will the present day chart in 2017 start to morph into a look like this? And eventually, will it take on a full bore bearish look? Absolutely, positively, yes. We don't know when that will happen, and that's why we take it day by day. And the only way that we can successfully migrate to a defensive stance is if we head into next week and every week with that flexible, unbiased, and open mind. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.